back. I'm real happy to be doing the intro to this one. This is a special episode, one that we've been waiting for. We have the GammaEdge folks for you guys, and I'm talking to you all as the market is tanking off of CPI after that initial draw up. And what's fun about that is that this is something that we actually talked about, that the GammaEdge folks, Paul and Taylor and John, who's there in absentia, we're expecting. And so it's so beautiful to be able to be watching this happen after they predicted it. Oh yeah, as always, my name is John Kirby, my co-host is Vic. In this particular episode, the charting credits are not going to Auc, but rather to GammaEdge themselves. Yeah, we hope you guys enjoy this. I love how they're able to break down all these concepts in a completely different but completely intelligible way. So yeah, I hope everybody enjoys it. Like, share, subscribe, etc. Yeah, enjoy. How did GammaEdge get started? What is it that you guys are trying to do? Just for everybody that's not familiar with the platform, Vic and I have had the privilege of being on there for a couple of weeks to get a feel for all your charts and everything, but for people who don't know already.
Yeah, I can start, Paul, and then you can come in with the specifics. But yeah, I mean, it really started as a couple guys bored at home during COVID quarantine. We got together in a random Discord group. For you guys that are familiar with the videos, so we kind of have the tick model and we have our gamma stuff. I was kind of looking at gamma stuff. Paul was looking at the tick stuff, and we were like, if we combine this stuff, it may be kind of powerful. And so we started going down the gamma road a lot because the tick kind of is what it is. We knew about that, and Paul and myself, we're not people to kind of take things at face value. We really like to dig in and understand the nuances of what's going on, and we really wanted to understand, okay, how is this stuff actionable? Because at the time, gamma this, gamma that, this is a big level, this is a big level, but it's like, okay, that's nice, but how do we make money for this? And we weren't satisfied with the answer that we were getting. And so really we spent 2021 literally waking up at 4 or 5 in the morning, downloading, I don't know, hundreds and thousands over the course of your option chains from brokers that would let us do it, and getting busting out our pivot tables, color coding stuff. And then and that same Discord, our third founder, John, back in developer, he was able to kind of create all the visualizations that y'all see for those that are in the Discord server. And yeah, and from there, really, the mission of GammaEdge is, we all know that gamma is significant. We know the options market is very significant these days, and it's really visualizing the option, visualizing the delta impact, and how we can make money from it at the end of the day.
Yeah, and I mean that's so cool that you guys can do that. Vic and I, we often talk about these like understanding options. It's like this four-dimensional or multi-dimensional picture that's really hard to understand just from the numbers. Sorry, I didn't mean to interrupt. If you want to say something too, Paul.
Oh yeah, just kind of going off of that point, like you said, gamma and options and delta, it can be four-dimensional and try and sound spooky and really analysis paralysis, right? But we really try to boil it down to what is important, what is not important. Don't get me wrong, we have a ton of information that those people that love that stuff, they can get lost in the sauce and 3D surface models and all that stuff that we produce. But really, we just try to produce actionable levels every day and hopefully make a little bit of money at the same time.
Yeah, I'm excited to get into those later. Paul, should I open up this PowerPoint and we should start moving on to this quad witching that's coming up?
Yeah, I think that's fine. And I'll just add a little bit of color to what Taylor said. So our third founder, John, he was in this other Discord with us, and he had reached out to me independently, and he was looking at CanSlim and stuff like that. So we started collaborating kind of behind the scenes of, this, that, and the other thing. And he basically just immediately was able to throw things together. And so I think, if you do come into the Discord and you see like what Taylor said, all his visualizations, the guy he's got a PhD in machine learning, and he's just pretty darn sharp on this. And plus he's He's now a beginning trader himself. He's compelled to take these trades and do them himself. And for us, that just brings a smile to our faces because here we're taking somebody who's interested in it, but now he's actually becoming successful with it. So that's kind of the takeaway that really I think is the genesis of this. How do we help somebody who is overwhelmed by a whole bunch of information and help them distill it down to the brass tacks and make money? And it's really about the levels. You guys have seen it. I know in BearTrap, you see us bounce back and forth between these different levels, and that's really what we're focused on, is identifying those levels and taking actions based on that. And that's what we can talk about as we go through some of these slides.
No, that's perfect. And I think people will see as well how ingenious it is to be able to put these things into a visual format. So I think it's really cool that you guys put this together. All right, let me get this PowerPoint open here. And here's a slideshow. Can you guys see it in slideshow mode like this?
Yep.
Okay,
Yep,
great.
Yep, all good.
Fine print, sure. And all right, you guys, this is your summary for December 11th.
I got a quick question, just not to interrupt before you do this, but just when you first start out within like an OPEX cycle, I know you might get to this, but I want to know kind of like what's your beginning thoughts before you put stuff down onto the PowerPoint? What are you guys thinking about?
Saw you, Paul.
I
know
think
it's a lot, but
well, to a certain extent, that's that top line there, right? Any truthful data can be tortured to tell the story you want to hear. And I think when Taylor and I start, we're trying to not do that, right? So whether it's OPEX coming up or it's just the middle of the cycle, wherever we are in ER or earnings reports and stuff like that, is try to be as objective as you possibly can. We all have our biases, and so when we were talking about doing this, I wanted to approach this. What do we have in front of us? So if I'm a new trader and I'm new to TA, I'm new to Gamma and Delta and all the things like that, how do I start? How do I just go? So I think it's a great question, because at the end of the day, the more you practice looking at this, I know Taylor and I, every day we're going through these charts, and it doesn't really change the week of OPEX versus a week after OPEX. It's what are we looking at? Does the thesis change, or does our position change? And you'll see that on the next couple slides. So hopefully that'll be helpful for the new trader or the experienced trader. And this will give you just another tool in your quiver there, or tool in your toolbox to move forward. Taylor, any thoughts?
Yeah, Vic, to echo what Paul said, I don't treat any day more important than any other day. I basically wake up, look at what the data is telling me. If something important is happening, it'll show up in the data, show up in the chart, show up in the visualization. At the end of the day, what I care about is the levels that we produce and where price is relative to those at the open, and how and if it interacts with it during the session. So
yeah,
no, that makes perfect sense. And I've seen so many times where, for instance, we will have something like a news catalyst, and then the levels will come back to bite, right, and be even more important than the news catalyst even was. So I think that these levels are so important for that reason.
yeah, it's funny you say that. Like we can't predict news events. We can't predict how prices specifically are going to act on a single piece of data that's released. But it's funny you say that, because we do see these levels tested time and time again when those events happen. So if it's a coincidence or not, I don't know. But I like
don't think
it.
so. I don't think it's a coincidence.
I don't think it is either.
it doesn't feel like one now, but it did at first.
If it were a coincidence, you'd be flipping a coin and saying, okay, whatever. We could do better than flipping a coin here. So.
Yep.
Okay, so we're trying to get this data to speak to us without expressing our own views through it. And so you guys, it looks like you're splitting it up into TA, and then you guys also have various different models that you're using.
Yeah, so I think just stepping back holistically, we want to know kind of what is going on, in the big picture. So as you've got highlighted here, the 16th is quadruple witching, right? And that's a big deal, right? So that's something that's going on this week, and people should know about it because dealer positioning around that is really, really important. And that's really the genesis of why you trade options, why we trade options, and why we're trying to understand this better. I think, in that framework of getting that, that awareness of what's going on this week, I didn't, put on here, but of course, Wednesday, what do we have? We have FOMC and CPI data, right? And we know those are volatile events, no question. So that situational awareness of this week, what that means, and then couple it with the other news things of Wednesday, gives you kind of, okay, maybe this week's going to be a little more tumultuous. At the end of the day, I think Taylor and I, just say, okay, we're aware of it. We know those are going to be big days, but what does that mean in context? And the rest of it's here, right? From you look at the TA, we don't get heavy into TA. We're not, and we're not knocking any TA. You'll see on some of the GammaEdge charts, not the ones tonight, but if you come into the Discord, we do have simple moving averages, the 50, the 21. We keep track of that because the market keeps track of that. We keep track of the TA that the market keeps track of, and we have several traders in the group who follow fib and do their own cloud analysis and things like that, and which is great. Bring your flavor of what works for you to the table, and I think that's the beauty of just this whole understanding the dealer action reaction thing. You can make it work with most of your systems, and I think that's what you guys preach at in your Discord and what we have in ours. So knowing situationally what's going on, knowing the TA, and then we get into some of the unique stuff for us. And this is where Taylor and I every morning, we talk about what's the market model telling us, and our market model is based upon this review of what we call the cumulative tick, and it's new to a lot of people. And that, yeah, exactly right here. And depending on the type of trader you are, you could be a long-term trader, like a position or a swing, or you could be a short-term trader. We have a number of folks who are flat at the end of the day. They go home with nothing but cash in their accounts, and they're happy. So you can look at this chart right here, and you can see that bolded white line, and the slope of that line tells you effectively what's happening in the overall market, the cumulative tick. And the tick, for those who are not familiar with that thing, is every time a trade transacts, doesn't matter the size, if it ends on chances are, if it was bought, it ticks up, and if it was sold, it ticks down. And so when you accumulate that, these are 1 minute bars here, when you accumulate that, you get the presentation that's in front of you, and then you can throw some moving averages on there to give you kind of a history. So Taylor and I watch this, and it helps you stay on the right side of the market generally for the time frame that you're trying to trade. And so we use it as an entry tool, we use it as an exit tool, and we use it as how to add to the positions. What's the market sentiment? So in the big picture, we start off, what's the market model telling us? So if you go back a couple slides to that original summary. Yeah, so you've got the short term, which is that white moving average that we just saw. Intermediate is, are we above or are we below that nice colorful ribbon that was in the middle? Those are the long-term moving averages. And then that one on the bottom where it says reset cash short, the bias for us now, because we're below it, is to sell the rips and buy the dips. Now, yeah, we went up today, no question. But in general, that long-term model will, it's a very good model to keep you out of trouble and allow you just to shorten your time horizon so that you're focused on shorter trades if that thing is moving up and down. And we've been, as you guys know, it's been a buzzsaw in the markets. So
Yeah,
Taylor and I focus on that part.
No, today was rough to trade for that reason too, even though we did end up going up. And I saw that you actually wrote, Paul, I think in your morning update, despite having this long-term model, you're still noting that, hey, today was likely to be an up day. And you wrote that before market open, I think, today. So it's not, seems like you guys are really focusing on the, analysis per time horizon in that way.
Yeah, and the last thing I'll say about this too is, yes, the tick is important, but there's also, depending on what kind of trader you are, like Paul said, just because the tick's trending down, the setup for the day could still be slightly biased higher. That's really where we're all traders. We have to take our own interpretation of what the market is telling us. So just to Paul's point, this isn't the end all be all, but it's certainly there is something for everyone. And for those out there today, if you're concerned, for instance, that the market ripped higher, this model is designed more or less to help you catch the meat of the move. Everyone says, the hardest part is the beginning and the end of the move. And so this model, it does allow you the opportunity to try and catch the very first move. We do have a signal for that. But that's also the most volatile signal. And if you're not bolted to your chair staring at the screen 8 hours a day and you're trying to trade that signal, it can be very tough. So yeah, like Paul said, short, intermediate, long term, there is a little bit for everyone here.
Yeah.
No, that's a great way to put it. I did have a question with tick, which is, I think I understand why you guys think this is so important, but for people who may not be as familiar, would you guys call this like a market breadth indicator, or why were you guys so convinced that this was the something to incorporate into your model?
So I've been using this. I developed this, this flavor of what you see over 10 years ago. I think just the success of keeping me on the right side of the trade has been great. So I think that's probably the first part. When I showed it to Taylor and some of the others, and Taylor, pick it up here, but I think the light bulb went off, and I'll pass the baton to you.
Yeah, I mean, so that Discord that me and Paul originally met in, it was a CanSlim focused trading style. For those that aren't familiar, CanSlim is like Investors Business Daily, William O'Neill, looking for those, growth stocks that are breaking out and have like really good earnings, really good sales. And one of the key factors is M, which is market. And that's saying, what is the market doing? Is the market generally in an uptrend or generally in a downtrend? Because if you're in the best stock with the best fundamentals and the market is going down, well, that stock is not going to be able to buck the trend that long before fate meets it and it starts heading lower. So what made it for me is like the cumulative tick is kind of like literally, as Paul was saying, it's upticks and downticks accumulated together. It's literally like, what is the market doing? And so for me, that was, kind of similar to moving averages and whatnot, but it kind of feels almost more real time to me of kind of what is the market doing. And we have another model too, the tick US. That's typically the first one that I review in the videos. We have this filter on it too, which kind of filters out for only big orders like plus and minus 1,000. Kind of everyone's consensus is those are meaningful ticks, so ticks up and down. So kind of combining that with what is on average the cumulative tick doing, plus do we have significant buying and selling, which we kind of think is kind of are the big boys, big girls, institutions playing in the move as well. So kind of confluence of those two things is pretty powerful.
Yeah.
That makes a lot of sense. Do you guys want me to move on to the next slide?
Sure. So one of the questions came in over the weekend about the moneyness and about the deltas, and I wanted to help address that. And effectively, what this was about is we get a lot of questions about what's expiring and what's it mean and all of that. So what this is one of the things that we believe is that sequencing matters. And just kind of stepping back before we dive into the meat of this thing, one of the key things about gamma analysis or delta analysis and understanding the dealers is that for a lot of people, this is kind of the, your eyes are getting open to something new here. When you open a call or, a long call, that dealer, there is a dealer on the other side. You're not doing this with another person, much like you could with a stock or with an inventory, just because of the way options are transacted. There's a registered dealer in the middle, and that dealer has an obligation. So if you buy a long call, they're short that call. And so, the dealers are like Goldman and Citadel, et cetera. And what's important about that is they don't want risk. And so if they're short that call that you opened, they have to buy underlying basically to effectively hedge flat. And so if you open a 50 delta on the long side, they're short 50 delta, and now they've got to buy 50 delta of the underlying or correlated instrument. This is a big deal, right? Because as you start opening these deltas, things happen, right? They either are buying or they're selling. So if you're closing deltas, like a door slamming shut, there's a natural dealer response. And so this chart, I think, this table starts looking at in some of the impacts for this week. So what we did, we took the biggest instruments, the SPX, and for those who are familiar with the SPX, it has two characteristics. First characteristic, it's cash settled. Now what that means is that at the end of the day, if you transact in the SPX, if you're profitable, you wake up tomorrow, you got more money in your account. And if you're not profitable, you wake up tomorrow, you have less money in your account. You don't get assigned anything. There isn't an SPX that you take possession of. That's different than like the SPY, the Qs, IWM, which are equity settled, right? If you're profitable and you hold across an expiry, chances are you wake up the next day, provided you've got enough money in your account, you're going to be holding 100 shares of SPY, right? So that could be a lot of capital. So this sets up two things that are really, really important. So the first thing is that when you open these calls or you open these puts, you're either going to be extremely long in delta as a complex, or you're going to be extremely short. And if you're long, you're positive, and you can see the SPX AM and AM plus PM are both positive numbers there. And then you can see SPY, Qs, and IWM are negative in the deltas. And so this tells you, when you look at these numbers, when somebody, whether it's GammaEdge or some other group out there, is showing you what the delta notional is on these complexes, and you see a positive number, you immediately go call dominated. You see a negative number, immediately go put dominated. Why is that a big deal? So without reading all the fine print down there, the takeaway is this. So we've got this week, right? We know there's a lot going on this week. We know, just based on the analysis, that the SPX, which is cash settled, has got a lot of calls in it. And those calls are going away. If we're long, this is always from the trader side of trader perspective. So the trader is long. Institutions are long calls right now, long delta. Dealers are short delta. I close that, I'm getting shorter. I close my calls. I'm going from +1 limit down towards 0. Dealers are going from -1 towards 0. They're getting longer. When I close a call, it causes the dealer to have to sell, because now they have to unload what they were hedged to. And that puts downward pressure on the markets. So latter this part of this week, one of the if-then scenarios, and we're very big on if this, then that. If we start seeing some of these come off earlier in the week, that's one thing. But if we don't see these coming off by watching OI, by watching the individual chains, we know that as we get further into the week, it's highly likely that we're going to see an event near the end of the week as the big boys and girls distribute these things out over time, right? They take what is expiring this week and they roll it out. So that's one thing. That's one if then. The other part is the negative stuff, right? The ones that are in the SPY, the Qs, and the IWM. This is a little different. It's negative. It means it's put dominated. So it's put dominated on the trader side. So there's a preponderance this week of negative deltas coming off in the SPY, the Qs, and the IWM. So I don't want to be assigned. So I'm actually going to close those in the money puts. So as I close those in the money puts, what happens? Well, now the dealer, who's on the other side of that trade, right? So if I'm long a put, I'm towards -1 on my deltas. The dealer is towards +1. If I close, I'm getting longer, going from -1 towards 0. The dealer's going from +1 towards 0. The dealer has to buy to get back up. We now get a rally. So it's going to be very interesting tomorrow to look at the OI change from today. And this is the assignment for folks. Look at the OI changes between the weekend and Monday, Monday to Tuesday, and start looking at the SPY, the Qs, and the IWM for this week. Because if we see that monetization, that explains the rally we have today, right? And I'm looking at the CT right now. The CT actually wasn't that strong today as things go. There was buying, no question.
Not CT being cumulative tick.
Being the cumulative tick, yeah. But the takeaway in this is that for every action on our side of the table, there's a dealer response on the other side of the table. And by watching the delta notional, and by the way, watching the gamma, but we're focused on the delta because the delta is what moves the market. That's the one thing that dealers are trying to hedge the risk out of. And you can see it right in these numbers. So we set up this contention, and that's really the takeaway of what we had here. Sequencing this week will really matter. If we start seeing monetization throughout the week, because remember, the SPY Qs are all now dailies, right? So as we start seeing this monetization, some of these numbers come off, we could fuel a rise up, and then boom, we've got the SPXA, which we think is largely institutional money. That is monthlies. The AM settled are the monthlies in the SPX. We could see a lot of distribution going on, which will put downward pressure on the markets as we go into OPEX. I don't know what's going to happen. You don't know what's going to happen. But this is the if-then that Taylor and I focus on. When we see this, we want people to be aware of the potential setup and then take it to the next step. What are you going to do about it? How are you going to react to this? Knowing, of course, CPI and FOMC on Wednesday. Are you going to sit on your hands? That's not a bad thing to do. Are you going to play volatility? That's not a bad thing to do. Are you going to play a possible rise in the first few days of monetization and then possibly a fall in the last days? Entirely up to you and the type of trader you are.
I think that that's a wonderful way to break it down, and something honestly that, at least to me so far, seems pretty unique to you guys is how you break down this SPX complex into the AM and PMs, and also just the way that that tells you who's on which side is wonderful. It's really good information. One other thing I do have to add is I think you're totally right about what happened today. I was looking this morning, and all the negative gamma was in SPY today. There was barely any in SPX, and that's what decayed to push us up. So let me put it this way: the first part of this, the decay of all those negative deltas here, has already started.
Right. The other thing before we move on here, I just want to point out, if you go over on that SPXA line, you go over to the right there, you look at that net notional gamma for the SPXA. Now, this is the mothership, right? This is the biggest instrument in the liquid markets in the United States. Look at that notional gamma level starting this morning.
It's nothing.
It's nothing. It's a goose egg. The dealers were positioned over the weekend as flat as you could be in terms of gamma exposure relative to the overall delta exposure. There was no sensitivity. They do this all the time. We see these zeros all the time. And really, that's what Taylor and I, we call out the zeros, we call out these areas, these pockets, these levels, because we think they're hiding places. We think they're parking places. And we think, you guys, us included, can identify those areas and put some bets on the table better than throwing a dart at the wall and just seeing, do I get a ton 80, right? That's not this at all.
I'm going to interject there just for a bit, because the reason this is so good is because, the edge you have by following and understanding the dealer flow, that's what we're all after. And man, I love how you guys break this out by indice. I never even thought about doing that like this. I mean, I kind of did it, but I did it on the gamma side only.
Sure.
And I just got into the delta side. In fact, John and I had a 2-hour conversation just talking about the delta exposure charts that we never look at in BearTrap. Everybody looks at the gamma charts only, and we're never looking at the delta charts. And so we're pretty new to the delta side of things and trying to figure out, where the dealers are positioned versus where their exposure is. And I think that's kind of what you guys are looking at here. Is going, look, the dealers aren't exposed here, so they don't got to do nothing, right? You're just going to sit there. So I love
They're
that.
not exposed to change, right? So that's what the gamma is, right? So the gamma is saying if the SPX goes up 30 points, does it go up in a non-linear or convex type of approach? And the short answer is not until it gets up to much higher levels, and they aren't the levels that we were at starting this morning. So they went the weekend effectively neutral. Now they've got delta exposure, but it's linear delta exposure because the gamma is almost zero. So
Right. Yeah, you got to put them together. You have to use them together.
So would it be fair to say that when we are in locations where our gamma is marginal, in other words, they don't have a convex exposure, it's linear, like you're saying, that at those moments we need to look at the delta to interpret what's going to happen or what's likely to happen?
Taylor can throw his own flavor on this because we both do our own analysis in the morning for the Discord. I look at both. I look at the 0 DTE, the 1 DTE. Now that's not part of this presentation, but if we have time, we can call something up and we can go over a few of that. But Taylor, do you any thoughts, any comments there?
Yeah, I mean, really what I'm looking at in the analysis I do is, where's the large gamma, but then where is the, where is the delta, where's the open interest as well? Where's the liquidity? Because even though the gamma may not be large at a level, if it's still a very liquid strike, meaning there's a lot of open interest activity happening at that strike, we see a lot of times that price interacts with that level too. So it certainly is nuanced. It's not black and white, kind of how everyone wishes it was. It does take a little just screen time, as you say, and just understanding, reviewing it, just kind of understanding kind of what the chart's telling you, and ultimately if price interacts with the level or if it doesn't.
Gotcha. Cool. Should we move on?
Sure.
Okay. Okay, these are the cool ones.
Yeah, so I don't know if you can make this full screen.
Yeah, I'll do that again.
Sure, if it's possible.
This is Paul's baby.
It's not a baby, but it conveys a lot of information. So these are, you can manipulate these once you're in the Discord, right? And I would urge you guys to play with them. You can see one of the axes is DTE, days to expiration. So you're effectively looking at kind of a sequence of time, and sequence matters here. Sequence matters. Everything is deterministic in options. So you can see on the left side calls and on the right side puts. And I've opened this particular one up for strikes all the way for the SPX because I wanted to really get the entire landscape. So kind of a short duration. I wanted to encapsulate the next 2 weeks. And so the SPX in our context, in GammaEdge's context, is both the AM settled and the PM settled. So there's only one AM, obviously, it's this Friday. And the PM is every day, right, of course. So one of the things that we're looking for, if you go right where it says ITM calls and you see that leader kind of pointing right up there, right at the edge there. Yeah, exactly. So that green on both of those means they're ITM. So when something's in the money, they're profitable. Deltas are tending towards, if it's a call, it's tending towards +1. And if it's on the other side, the put side, deltas are tending towards -1. Why that's important is that the boundary between the green and kind of that yellow or orangish area is the strike price. And when this chart was done, it's the third line in the middle of the page there. It says 39.4204. So The middle boundary between the yellow and the green is the boundary for, you know, the as evaluated spot price. That matters. Moneyness matters. And so what these charts are looking at is they're looking at something called delta moneyness. And what we're trying to determine is where's the big money and what's the deltas associated with that money. And we know a couple things. We know that the further away from that boundary, deltas are going to be at their limit. They're going to be at +1 on the call side, or they're going to be at -1 on the put side. That means there's an implication here. That means there's no more delta hedging. So here on the left, where you see the calls, you see those strikes all the way down at 1,000, 1,500, $2,000. Their deltas are effectively +1. There's no hedging going on, right? The dealers long time ago took care of that. There's nothing to be done. Now, as we move up the strike chain, you don't have the resolution in this plot, but if you narrow the strikes down to, you know, ±20% off a spot, you'll start seeing other things in the surface. And I know people have heard the word charm. Charm is that natural, as time marches forward, if something doesn't have a delta of +1, but it has a delta of, say, 0.6, 0.7, 0.8, as we march through time getting closer to expiry, charm flows on the call side will push basically upwards towards the limit, and that'll force the dealer to have to buy, right? So we see a call dominated charm structure, which you can view with these 3D plots, looking, you know, the next few days in time. You get a real good sense of, are there any charm flows available for the dealer to have to respond to? So in the absence of any monetization, what happens here is that, you know, if you're just kind of grinding through time, we've seen it, we've all seen it. We've seen just kind of this natural undulation, then we pin somewhere, and we typically pin at a gamma level or a pretty dominant liquidity level. So I'm always looking at these 3D charts. I'm looking not only where are the icebergs, you know, these big spikes, but I'm also looking at where do we see these little undulations close to that boundary, and are they starting to approach something where, you know, effectively the gamma level could be, or excuse me, the delta level could be limiting at expiry towards +1. I don't see a lot of that here, right? I don't see a lot of it relative to what's going on in the wings. There is a lot of money that is profitable money that is set to expire or be awarded to, because it's the SPX, it's cash settled, be awarded to those holders this week. That's a big deal. And so charm flows are probably non-existent relative to the landscape that we're in, and more importantly, some people have got to make some pretty big decisions this week. And this gets us back to what we were talking about, that positive delta and that moneyness, or that large delta that we just saw on the previous slide. When that comes off, when these deltas come off, remember, the dealers are already hedged. Now this goes away. Something's got to happen. And we're going to see that either unwind through this week, which will be downward pressure, we think, or it'll happen after expiry, after settlement, which will be partly Friday, because remember, this stuff settles at the open on the SPX-A, at the open on Friday morning. You'll have all day Friday to adjust for whatever the volatility is. Go across the weekend, everyone's going to have margin calls and assignments and all sorts of stuff, and then you're going to see some panic, most likely Monday, Tuesday next week, and that volatility will continue. We didn't talk about it here, but I just want to add, Vixpiration for the monthly is actually next Wednesday, not this Wednesday. That's not normal. And the fact that Vixpiration is actually next Wednesday means Tuesday of next week is the last trading day for the monthly VIX. Why is that a big deal? People use the VIX to hedge the SPX and vice versa. Now it's reversed. And we've seen, and I put it in my morning notes this morning for everyone, go back in time, go back a few months where this has occurred in the past. And sometimes the market gets it wrong and we get really volatile. So there's a whole series of things setting up. But the takeaway for this, you got a lot on the call side. It's already hedged. So there's no charm. What happens when it comes off? And just your eye immediately can look at this and say, aha, there is a big imbalance here.
I don't want to interrupt you here, but I just want to interject for just a second, because I want to just, how incredible it is that you can look out into the future and already start making some really, really solid assumptions about what's to come. And then you have this roadmap and you go, well, I expected X to happen and it didn't. Sort of like with this Vixpiration thing being on the small Vixpiration on the 14th and then the big one on the 22nd. I think a lot of people think it's on the 14th because it usually comes with FOMC, right?
And in the week of, it's usually the Wednesday preceding the monthly. But
yeah,
this month there's a few months of the year that it actually flips. And
so being able to look ahead at these expiries and being able to make some analysis and assumptions like this is so incredibly helpful to how you can plan your trades around it.
We think so.
Yeah. So
I had a question too, actually, related to that, because you all of those VIX options are I think it's 21st, 22nd. Either way, they're for next week. They're expiring there. Did you say, Paul, that you think that the SPX has been used as a substitute for the VIX in this particular case because it was expiring at the right time relative to all these events?
Typically, yeah, I think that's it. And typically the VIX expires the Wednesday prior to the monthly. So this week, if this were a normal week, we'd normally see the VIX expire on Wednesday, last trading day being Tuesday. And then the SPX AM's last trading day is Thursday, with the SPX settling at the open Friday morning. And that only leaves the SPX PM to kind of carry the balancing and hedging weight of wherever they are for the week. So normally we see the VIX change hands as it rolls off, and we see some hedging going on for the next 30 days as they roll those out. So they're positioning. You remember, VIX is a forward-looking instrument, right? 23 to 37 days in the future. And so we tend to see that kind of leapfrogging as we go forward in vol play and stuff like that. You're not going to get that this week, right? So basically, we're going into this week, and there's no hedging adjustment afforded by the VIX. I mean, you can do the weeklies, but they're not. The volume is not nearly as big as the monthlies. It's next week, and so right in the middle of all of this, we think Vixpiration next week could also add a little more uncertainty to the equation here. So it'll be interesting to see how it all pans out. I mean, it's not a surefire, place your bets on a vol expansion or a vol collapse, but it's not standard. And I just urge everyone to go to the CBOE calendar. You can look this up yourself. You don't need us. Go to CBOE calendar, look it up, and just go check those dates, and then go back and look at the volatility around those dates. Go look at the markets, and I think there you go. That's it right there.
Yep.
Bam.
I have this always on my desk, and the reason I have it is because every single change of direction or crash is always around a Vixpiration. Or not every single one, but they tend to cluster around there, and that's why I'm actually both illuminated and confused by what you're saying, because I was looking out at this 21st Vixpiration as, okay, we'll have some stability through these events that's afforded to us by that. But if what you're saying is right, and a lot of the hedges that are normally in the Vixpiration are concentrated on, the 16th, this Friday, then that changes that picture for me completely.
I wouldn't say they're concentrated on the 16th. I will say that the 14th, this Wednesday, would normally be the day that they rehedge for the next month or the next 2 months or whatever the case may be. But now they're delaying that a little bit, right? I mean, They can still do it, but we see that imbalance. And so just something to be aware of, right? It's a non-standard. So you can see that little green half triangle there through the 21st. And if you go back in time, you see the, on the 16th, it's kind of that orangish thing. You can go back and take a look. Looks like July had one. Looks like April had one. and it looks like January had one.
Yeah, the so-called 5-week expiration gap, window of weakness. Yeah.
Exactly. So something to pay attention to. And what you'll see is the redistribution of those hedges, those volatility plays are going to be shifted in time. And that, I think that against the big money has a role to play. Remember, VIX is orthogonal. The only thing in common with the VIX and the SPX is that as VIX goes up, typically SPX is coming down and vice versa, right? Because it's a measure of the demand of the at the money options there. And so that inverse play gives you some comfort when you're trying to hedge your portfolio. Now the expiries are not exactly in sync.
That makes a lot of sense. It's not as good as a hedge because it's almost operating like a calendar, right? In other words, yeah, I hope that's clear for people. I don't know how to explain that better, to be honest. Cool. Let's keep going then.
Sure.
Here we go. Okay, so we've seen this. You've talked about the calls already. What about these puts? Is there anything that we should be looking at here at the put delta money list?
Oops, sorry about that. The short answer is the fact that there's very little put dominance out there relative to the call dominance is significant, and that's all we'll say about that. And at the end of the day, we've got far more calls that are either going to get monetized this week, even when you net them against the puts. The calls are going to win. The delta slamming shut from +1 limit down to 0. It's going to create something. Now, you'll see in some of the charts coming up, sometimes it's balanced. It's a nothing muffin. Sometimes it's not balanced. And when it's not balanced is when I think there's opportunity. And that's how we play with some of these charts.
What do you think about this and the Santa rally that I hear about coming up?
Well, the Santa rallies, it's not a guarantee, right? We may see something. We may not see something, right? If we're going to see a Santa rally, let's step back and say, what would be the conditions for a Santa rally? We'd want to have charm. We would want to have basically calls that were not maxed out in their deltas. We would want to, as we march through time, we'd want those calls to be a little bit further than our time frame, and so that the deltas and the convexity of that increases as we march through time. So day over day, as we get closer and start clanking down the DTE, basically deltas are going up, and that effectively results in a dealer response where they're having to buy the underlying. So let's just say that's one condition that is supportive of a melt up, which we have heard, synonymous with Santa rally type thing, right? The other thing is if you go back to the other ice charts there, we want to see effectively some fuel that is on the put side, so that profitable people who banked well and were able to monetize, remember, these are equities, as they bank those puts, they're closing those puts. So they're getting longer, dealer's getting shorter, dealer has to respond by buying the underlying. There's your rally. Right? So we would like to see the right side of these plots have more put dominance in the time frame that we're looking at than have call dominance, because calls that are in the money also are suggestive of being closed, and that's a downward pressure in dealer response. So we would want to see something maybe on Apple, for instance. Apple, just looking at it without looking at any hovering over the numbers or anything like that, is kind of the setup for a rally, kind of. And let's see, Amazon, perhaps a little more in there. Not saying they're going to rally. I'm saying the setups are conducive that if those puts get monetized, it will put pressure on the dealers to respond accordingly in the time frame that you're seeing here.
That makes a lot of sense. Yeah, and it's interesting your guys. Oh, I guess in this case it's just alphabetical, right? That these particular charts are here.
Yeah, I just grabbed them. So in the Discord, our Discord, we have a grouping called the liquidity stocks, and effectively we took the SPX and the Qs and we took, I don't know, the top 10 or so of each, and we sorted by their weighting within the index, and then we automatically generate these charts for everybody, so you don't have to bang them into the Discord. So you can just peruse those channels very quickly if you're doing your analysis. And I don't know how Taylor feels about it, but if you can't make money with the liquidity stocks and what you're seeing, then chasing some thinly traded stock is probably not in your best interest. I don't know, Taylor, anything to add there, bud?
Yeah, I mean, I only focus on SPY, Apple, Tesla, really. I mean, those are the big boys. That's all the eyes are, and from what I've seen, those are what obey their levels and whatnot next. So I try and keep it pretty simple than making it harder than it needs to be. They all pay money the same, right?
They all pay money the same. It all looks the same in the bank account.
Just related to that, but do you guys distinguish between, so for me personally, for instance, I when I look at SPY, these super liquid names which have a lot of options volume relative to the overall notional traded in terms of the underlying per day, I'll look at Gamma differently than, like, let's say, I mean, these might all be in that category, but with stocks that are let's say that there are fewer options that are traded than the stock. I'll look at the options more as a sentiment indicator and less as an indicator of dealer pressure. Do you guys have a similar distinction, or not so much?
I think if I'm understanding your observation, I think you and I actually talked on this also when we were doing our one-on-one. I think the ratio of notional of the options to the underlying, it plays a role there. So the more stock open interest and volume of that open interest, the more that the price responds, and that makes sense because of our understanding, or our assumed understanding of the dealer flow. So I think the larger the stock and the larger the OI and the volume of that OI relative to the underlying, yeah, I think there's something there. We work closely with a company called EdgeRater for our back testing, and we have found that lower OI stocks statistically don't perform the same as high OI stocks and high relative ratio to the volume of the underlying. So I think there's a there, and you want just stick with high volume, high OI, in demand stocks. And like I said, and Taylor said, if we can't make money with those, it's chasing something that's small. You can still do it, but Gamma and Delta, when there's very little dealer response, probably isn't going to be the edge that you're looking for.
Yeah, that makes sense. Okay, so we have a ton of these different ones. Are there any ones in particular that you wanted me to pull up?
Well, a couple things have been catching my eye. If you go to where Bank of America, BAC, it's a bank, of course.
Yep.
There you go.
Here we go.
Right? Yep. And you can see Bank of America is actually set up in a way that is kind of suggestive of potentially some monetization and potentially some move upwards. So you look at that and you'd say, that's interesting, because banks in general, fintech, XLF ETF, the spider, is not doing very well, right? And that's of interest. While we're here, take a look at CVX. That's energy, right? So energy, puts on energy. You can see exactly right there. You can see that there's a lot of in the money puts with some serious delta moneyness associated with it also. And so that, unless those people want to hold CVX or want to hold BAC, and these are puts, right? So unless they want to hold them short at those high levels, which is fine, it's a different risk profile, they'll probably start monetizing. So you take a look at those. Now go down a slide to, let's look at JPM, for instance. Yeah, right there. Look at JPM. JPM is the #1 stock in the XLF, meaning in weighting. It's completely opposite in its structure. So JPM's just had a heck of a run. It went from below 115 up to where it is in here. So it's up in the 130s somewhere in that zone. So it's had a heck of a run in a very, very short period of time. And the takeaway here is that you can use this information to get an overall thesis of what you think an individual stock will do in a time frame that you think it's going to do it. So I know a lot of people in GammaEdge, took the JPM trade. It was awesome key levels, so what we call our zero gex and our plus trans, and we ride those levels to the next layer, next level up, adjusting our stops up and doing whatever magic we do there. But this is telling me it might be time to take JPM off the table. And it tells me that there's a monetization event pending a few days out from now. And so you want to be, you don't want to be greedy, but this is telling me there's a lot of profitable people and there's no counterbalance over on the put side. So, when I look at these charts, I'm always looking to see, for instance, where's my thesis? So if I think financials are in trouble, I got two mixed signals here, right? I've got JPM, which is telling me it's run pretty far. I got BAC, which has been beat up. It's got a lot of puts there. Maybe it's time to take a flyer on these things, look at the market model and say, which direction do I think this thing's going to go? Well, if we're in a down market, XLF, which is the broad index, is down or has been getting hammered, and JPM is the largest one in the chain. Maybe JPM, maybe that's the trade I want to take, and maybe put some puts on or something like that.
So since you're talking about it, I just figured I'd pull up the delta moneyness for XLF. And here it's looking like broadly it's mixed, right? It's a mix of those two underlyings.
Right.
A little bit more on the call side over here as we'd expect, which is consistent with that SPX picture that we have, right?
Yeah. Yeah, one thing to point out, the scales, when you do these charts, the scales on the Z-axis, that's the magnitude axis of, how big the spike is or how big it isn't. They're the same. We ratio these. So you can immediately look at the put and the call side and the gamma and get an immediate inference of what you're seeing. Yeah, exactly. Yeah.
Yeah, just so that everybody at home can also see how this works, right? And I can turn off this. I have this thing that basically makes my screen dark so that we can see it even better. Yeah, that's really cool. That's really, really cool.
And so you can net those against each other, I guess is what my point is, because that Z-axis, that vertical axis, the one that says 50,000 on it, you can see that the magnitudes are not the same. And you can also look out to DTE. Sometimes when you plot these things out, 25, 30-day, 60-day DTE, you'll see different rows of spikes in different DTEs. And mentally, you can net these things out and say, where do I have the balance, or where do I have a shift? So it allows you to form a thesis about monetization, moneyness, and what you're thinking fear and greed means for the particular underlying that you're studying. So you get to see where the traders are thinking and where they're sitting on their, in their overall profitability or lack thereof.
No, that makes perfect sense. And I can compare these directly, right? I have my 20K right here for this particular expert. I'm assuming it's the same one, and it looks like it is. And then over here, 20 to 55 or so.
Right.
At least XLF, just as an example.
Yeah.
Very cool.
So, we use this. I think you're right. It opens up the landscape for us and allows us to kind of see what's out there and when it's out there, right? And that can be beneficial.
I'm just looking to see what other toys you have for us today. Oh wow. Okay. So what is this?
Taylor, you wanna talk about this? You want me to?
Yeah, I'll give the overview. So this is this is one of our power users, we can call him JB. He we call this the fish pond map, but essentially what it is, it's our GEX ratio, so it's taking a cumulative cumulative gamma, and cumulative negative gamma, cumulative positive gamma, cumulative negative gamma. And so you can kind of think of it as like a ratio of greater than 1 meaning there's more call gamma in the complex, less than one, more put gamma in the complex. And yeah, through back testing, we have just found that there are ideal spots of when you should be thinking, hey, this is an interesting spot to get long. Hey, this is an interesting spot to either get short and or potentially take profits. The way I think about this, it's kind of more of a condition of the market. I guess you can think kind of overbought, oversold, if you will, versus necessarily a trade signal. I like to pair this with some other indicators if we're at an important level, kind of what the cumulative tick is telling us, and then also slapping on this kind of condition of what the market is in. Are we heavily weighted to puts? Are we heavily weighted to calls? So yeah, this is just kind of another visualization tool that we offer.
So okay, so we're basically taking the typical put call ratio and then just putting it in terms of put gex and call gex, and then that's beginning of the day for each of these tickers.
Effectively, we think PCR is kind of limiting because one of the, kind of backing up here a little bit, one of the levels that we do track is something called COI, or call open interest, and POI, put open interest. And a lot of the other services do this too. And that just answers the question, what strike, if I were to take the complex, the option complex, and I were to flatten all of the expiries, so all I have are the strikes, and I add up or subtract all of the puts and the calls, whether they're short or long, all that stuff, which strike has the most calls in it, COI, and which strike has the most puts in it, POI. The problem with that is in the process of doing that, which is exactly what put call ratio is, by the way. It's the ratio of POI to COI in that put call ratio. You lose all time. So if you study the SPX and you look at the expiries of the SPX, you'll see the SPX goes out a long ways, right? And people put a lot of money a long ways away, but it counts towards the POI. Now people like tradingvol.net and others, they shorten the horizon, which is fine. It's arbitrary, but it's fine as long as they stay with it. The problem with that is it doesn't give you a sense of this week or 2 weeks or 5 weeks. What does? GEX, gamma ratio. GEX, by its nature, gamma is a shorter term phenomenon. So we created the GEX ratio, and we've extensively tested the GEX ratios, again, using our partnership with EdgeRater. And what we have found is exactly what's in that third bullet. If you want to just take a broad brush at rules, when you see 0.06 and you've hit a low and you're coming back up, that 0.6 is a nice place to get long. Not saying for anyone to do it, not recommendation, not a trading advice, but that's a nice number to go long, because chances are after you've bounded down into the reds that you see on the screen, you'll start moving your way upward. Same token, when you're in the greens and you're up around that 1.2, 1.3, 1.1 area, you can usually take the money off the table. You might even think after you peak out and start coming back down towards that 1.2 of getting short. And if you take a look at the bottom there, you can see where for many of these things, well, that's the daily change, but if you take a look at the 8 December line there, a few days old, but you get the idea. Some of these are getting into a position where it might make sense where you shouldn't be long these things anymore, and perhaps you want to be short. Why is it important? GEX ratio is the short-term measurement of basically bullish speculation to bearish speculation. And when we see that number getting smaller with the puts in the denominator, it means that the bears are growing, and that they're thinking shorter term, we're going down. And we look for that. We look for prices going up still, but now the GEX ratio is starting to fall, that divergence again. And almost always it resolves itself. It's hard to fool the market. So one of two things is going to happen. Either price is going to come down to follow the GEX ratio, or the market's going to say, okay, our thesis was wrong, and we're going to go and we'll see calls get added, and you'll see that GEX ratio turn back up towards price. It's usually not that latter. It's usually we're going to come down and follow. And so it gives us an opportunity, and that's what the balance of the slides are in this deck, are just different perspectives on the liquidity stocks and what we're seeing go up and what we're seeing come down.
Yeah, that's beautiful, and it also kind of like between this and then the ICE charts and the cumulative tick, it almost seems as if the way that you guys think is really a matter of bringing gamma to the entire market, or reading the gamma of the entire market.
Correct.
That's wonderful.
It's a mosaic, it's not any one particular thing, it's interweaving the various tools and what they're telling us to craft through our lens kind of what we think.
Yeah. So I mean, that leaves us with a lot of tools, honestly. I wonder, I don't know if you guys have maybe we have another 10, 15 minutes, something like that.
Yeah, I mean, we don't. I mean, there are other tools that we have, and I think these are the ones that can help people kind of understand the landscape and how to read the landscape. A lot of folks in GammaEdge, the market model helps tame them down. It teaches them patience. It taught me patience. You don't enter long when that cumulative tick is falling, that white bolded line is coming down. You wait for it to stabilize, right? Let it work its way out. And as it starts going up, you can start getting progressive exposure as it works in your favor. And if you can, that same power user who did that GEX ratio chart that you saw there, JB, one of our key guys for users, he has some very definite rules on entering a new position. Like Taylor said, you better be buckled into your seat because it's going to be a heck of a ride. But he takes his own medicine. He follows his own path there, and he gets into the CT when it does its things, and he's been pretty successful at it. So I think there's a lot, depending on the type of trader and the time frame. Time frame matters.
Yeah.
When we started this tonight, you asked about the rise today, and I frankly, just looking at the cumulative tick today, it didn't even break higher than its high on Friday. So even though we went up today in the markets, it's not met by what I would consider huge broad selling or broad buying, right? It went up, but it didn't go up. We know what signature buying looks like in the markets. And Taylor, do you see something that I'm missing here? Because I'm not seeing anything that looks compelling to jump in with both feet on the long side.
Yeah, no, I mean, like we always say, kind of the cumulative tick cross of our shorter term moving average ribbon, every rally has to start with that. That doesn't mean that every signal like that is going to lead to a rally. So like we were saying earlier, very, very fickle signal right now, bolted to the chair, but yeah.
And go ahead.
No, I was just wondering how you guys so if you guys personally are sort of like longer term or shorter term traders, like are you guys going to maintain any exposure through this wicked week?
So I am long right now. What am I long? I am long silver. I am, which is okay. It's doing fine. Not great. I am long UNH, which has been getting beaten up. But these are long-term holds. It's been getting beaten up recently, and I am long. Let's see what else. XLC. Not doing all that positive right now. I may choose to get out of that trade. Let's see, what else am I long here?
Oh wow, I had looked at this XLC chart. That looks monstrous.
Yeah, well, I was thinking Perhaps there was a Santa rally in there somewhere, and from a TA perspective, it looked kind of interesting to me. But I think it's failing. So this is one of the things that you don't get a lot of exposure. I am looking. I see the VIX today was up quite a bit. I see the VVIX is up quite a bit. So I'm looking at that, and I'm also I'm a seller of this market, as many people who know me are aware. I like to place long-term hedges to the downside. So I like to buy as we go up, or like to sell, I should say, the market as we go up. So if we cross 4,000, I'll probably be selling way down somewhere and doing something of a some sort of put collar or put spread down below.
That makes a lot of sense. It was honestly satisfying to hear a lot of this presentation because I do two things. I have a portfolio of sort of longer term equity positions, which is mostly cash right now still. But the way that I have an odd calendar where I'm long into the 16th and then short into the 30th of December. And I've had that on for a couple months, also just using Gamma. And yeah, it's a satisfying feeling to know that you can position slower because you're watching these bigger moves take place. This overall positioning that is gradual, that has to build up.
Go to slide 5 there, or slide 4, excuse me.
Yeah.
This is not my work. This is just it's my screen, but it's borrowed from other thought leaders in the space. So that red line where the call out is the JPM hedge. There's 44,500 short calls sitting at 38.35. Why that's a big deal is they are not liquid. They typically roll, they roll every quarter. This is the biggest roll of the 3 funds this month. This end of month is going to be the one that matters. Those red down arrows that you see there, I think are important. And they're not important from a gamma or a delta perspective, but this is where TA really matters because the market is looking at this. There are whole, disciplines who watch charts and they program all sorts of things based upon these patterns. And this is a very recognizable, very easy pattern. And so I think you can see that uptrending line that forms the recent lows and intersects right around that 40-60 type area just in a few days actually. But you can see also that red arrow that's pointing down towards where that call out is. It doesn't mean that we're going to go down in a straight line to 38.35. But remember, we're in the money on short calls, and it's a big delta number, right? And it's just going to get bigger because we're in the money. So those short calls when I checked over the weekend, they were about 0.6, minus 0.6, right? And so times 100 times 44,500, et cetera. Now you got some real money out there. You got some real delta. And if we stay in the money, those deltas are going towards -1, which means the dealers are going towards +1. Now this is a quarterly expiry at the end of the month. Right? So it's a little larger than your normal monthly expiry, but it's got a downward weight sitting at 38.35. The dealers are having to constantly sell as we go through the month. This is a boat anchor. This doesn't normally exist, but it exists this month. So we can certainly bounce back up towards that trend line where those red down arrows are, right? That downward trending line. And there's no question, that's over 4,000. We could certainly do that. I don't think we're going to get much higher than that, right? If there's not a lot of impetus to break that line and hold it for next month's earnings reports, earnings season and all that. Plus, we've got this boat anchor called JPM. I think when you start taking all these things and you start taking the deltas and knowing that you got all these call monetization possible in the SPX, et cetera, these are just downward weights on the overall structure. This is the visibility that this type of tool, these tools can give to the normal trader. And so I think you form a thesis, and this is kind of the parting thought here. You form a thesis. You try not to tease the data or torture the data to tell you what you want to hear, but you look at it and say, the TA model is kind of range bound, and it's got an upside and a downside. Okay. We got the gamma level. It's kind of telling us a couple things. We got the delta levels. They're kind of telling us a few things. Okay, I got a thesis. How do I play it? That's individual.
Yeah, and then you can continue to adjust that thesis as you see all of your data changing.
Right. It's a heck of a lot better than throwing a bunch of darts at the wall.
Yeah, that makes sense.
I would say it's quite a bit better than that. I don't know how many times you form a thesis. I don't know how many times I've done this, and I don't have near the knowledge or the tools that you guys have. And it comes to fruition just because you did exactly what you said. Was just look at the data as objective as possible, and then let the thesis kind of form itself.